Welcome to the third and final session of today's conference, and thank you so much for allowing me to chair this. So this session is normally entitled Money Inflation in Central Bank Models. So given I work at a central bank on models with money and inflation in them, I'm very interested to hear what each of our speakers has to say. As someone I think mentioned in the first session, on the staff at the bank, we do have models with money in them in our suite of models that we use in the MPC forecast process. But as Tim says, different members of the MPC and different people at the bank will place different weights on those models and on how we view money relative to other indicators. So it'd be very useful to find out what everyone thinks about the models central banks have and how we use them. Now, we have three excellent speakers in this session. So as in earlier sessions, we will let each speaker give their paper in turn, and we'll have plenty of time for discussion and questions at the end. Although Victor, our first speaker, will unfortunately have to leave before the discussion. So if online participants have a question for Victor, could they put it in the Zoom Q&A, and then we can forward those on to Victor a bit later. So as I said, we have a great lineup of three speakers. And first of all, I'd like to introduce Victor Murinde, who is the AXA Professor at the School of Finance and Management at SOAS University of London, and is the founding director of its Centre for Global Finance. He was also the founding director of the African Development Institute at the African Development Bank between 2011 and 2014. And Victor has contributed extensively to the financial economics literature with over 100 papers in the areas of banking and finance, development finance, and financial markets. And Victor's paper is on how should developing countries react to the current upsurge in global money growth. So Victor, over to you. And you have about 25 minutes.
Thank you very much, Rayland, for that generous introduction. Let me start by thanking Tim and Joanne for inviting me to this interesting conference of the IIMR, and also to task me to make a presentation and a paper shared in development on how developing countries should react to the current upsurge in global monetary growth. An interesting idea for central bankers especially. This is joint work with the Astina Petropoulou, who is my postdoc research fellow at SOAS. It's interesting because at the outbreak of COVID-19, central bank governors in developing countries, but also the Treasury, Finance Ministry of developing countries, were more or less trying to design packages, and they were trying to learn, as in the learning process, from what was happening in the industrial world, especially in the US and the UK, and trying to see what packages should be in place to safeguard the flow of funds among households, enterprises, and the special role that central banks would have to adopt, to cope with the potential monetary freeze. And so this workshop and this paper, are very timely. And I just going to take a very pedestrian overview of this and just give an introduction on what do we know, where are we. I also think about the economic theory and the way to generate some plausible empirical models. Rayland was mentioning the way money is integrated by central bankers. So I'm not going to put forward a model, a VVAR, or any type of the models that we associate with the central banks, but I'm just going to highlight the economic and empirical foundations. I then just take an excursion on what is happening in terms of money growth and the fear of inflation in the main developing countries in Africa and Latin America and Asia Pacific, and then in emerging Europe, Middle East, and South Africa. And then I'm going to pose, just try to answer the question, at least initially, on what central banks, how central banks should react. In terms of what we know, it's very clear, and having come late into the conference, it's possible that colleagues have already covered this area quite competently. Nevertheless, I can just highlight very briefly that the money supply in the US, of course, has been rising. I think the break from the past since the 1970s, whereby basically we've seen a rise of about 12% year over year in April, according to the Center for Financial Stability Division for Money for Index, including treasuries. And so this has been meant a phenomenal rise, as you can see on this chart, basically trying to track the developments in US money supply, the M2 measure, all the time, and then this big peak that appears from about the outbreak of the COVID-19 to where we are at the moment. Of course, this is also associated with the QE in the US since COVID-19, and of course, the various in the US Fed Reserve, the announcement of the amount of a QE initially by March 2020, mentioning a 700% billion increase, and then the extension later on in June, extending this program to commit more funds, QE funds. And so the question here is how this monetary growth, especially in the US, just proxy of the global monetary growth. And of course, the fear that inflation, which I think almost was becoming a thing in the past before, how the new fears of inflation and how this would happen. Perhaps for us to visit the channels in which money growth and inflation normally associated with the flow, how it transmitted from OECD countries to developing countries. We know, and in some of my recent work, I'm interested in to see how shocks in the banking systems are transmitted from industrial countries to developing countries, and the channels, the transmission, channels. It's almost there is some parallel here because the channels I'm gonna explore here will include the commodity price channel and the commodity cycles, the exchange rate channel, and then of course the to do with the inflation expectations. And I highlight that very much because the inflation expectations at the global level trickle their way, somehow to the behavior of central banks and economic agents, especially companies and households in the developing world. If you take, say, theoretical tractable models and say, for example, the argument that came up, this is possibly a couple of many years back, that tried to consider what were then termed as the Caballo effect. I remember, doing a lot of work here in the late 90s in terms of trying to look for the supply side sources of inflation. Take a simple production function, take a labor market and assume clearing or even non-clearing, and then derive an aggregate supply, and then try to interact that with the balances in money supply and in the physical accommodation of that money supply. And then what we would get then is, of course, prices being formed on the supply side, which is different from prices being formed on the aggregate demand side. There are indeed aggregate demand pressures, and that can be taken into account. But here, the models will be looking at the supply side. So these models have a story to tell, but maybe the story is different if we look into the perspective of COVID-19, money growth in the US, and of course, the QE phenomena of quantitative easing in the world, which actually was not restricted to the US and UK and so forth. But as I said, central bank governors were busy watching what's happening in the Rosary. Minister of Finance, and in the areas where I work actively, say in Africa, it was just like the outbreak where the everyday engagement with key people in terms of how to respond with terms of packages. And of course, also we can think in terms of economic theory, the way inflation expectations form, and the diffusion of these expectations across agents, both in industrial and emerging countries. The commodity price cycles is of interest, and I'm finding here to paper with the Botiano in Canada, and also Yusuf Somalia, also in Canada, where we are trying to look at the way the credit cycles work. And we find that actually the main transmission channel is through the behavior of commercial banks or through the banking sector, whereby the foreign banks have a huge impact on the behavior of basic banks or domestic, financial systems. And so it's also plausible that actually the money growth in the industrial countries can actually affect the behavior of the domestic banking system, especially the big banks in Africa, the Pan-African banks, but also the nascent financial markets and the price formation process in the financial markets. Indeed, one could take, for example, this is one of the equations used in the Hunt Cloud work at the Bank for International Settlements. I think they did capture actually the specification. You can derive this. This is a kind of reduced form, but it could be derived from many other models. But what it does basically, it captures here the inflation which arises from, say, persistent. This would be inertia. We have no inertia now because we are not coming from a history of a very rapid inflation. Okay, so the inertia might be very limited or not significant at all. But then you have the output gap, and this have happened because maybe depressed production levels, the COVID-19 on production processes. And here is possibly what you would get as the important culprit in money growth, where here this is tying down the deviations of money supply growth from the trend, from trend money, and that gives stays on the domestic economy. But of course, this is a kind of domestic. These are where the central bank governors I mentioned were trying to see how they could support packages initiated, especially by governments. And I think this tie down what hypothetically I could call them in transmission channel through the exchange rate. The exchange rate pass-through exercise is done almost on a monthly basis, coordinated by the Bank for International Settlement. And many banks in developing countries participate through their June meetings, in which I've been party to. They mainly do two ways, doing the sample of the pass-through coefficient, and then they calculate the coefficients to see the departure. And the exchange rate pass-through becomes a very important phenomenon for transmitting inflationary price changes to developing countries. And of course, you have the other traditional variables, the wages, and of course, the shock variables from import prices, from food prices, and from oil prices, especially not exclusively, but oil, especially oil importing countries. And so what you have in this specification, which could be expanded, which could be extended, you could put in, say, it could account for the growth in technologies in Africa, Asia, the emergence of fintech and mobile money or other forms of money that are transmitted and do impact on the way the behavior of companies. So could be expanded to do that. We have not gone beyond the stages of the data and the modifications we can make on this. So what I will do is basically highlight what we observe so far on a background story of what has been happening across a number of developing countries. If you take, for example, the Sub-Saharan African story, you see just phenomenal that pre-crisis, this price inflation based on CPI, pre-crisis, and then you can extend the trade preference. But if you actually look at what happens after the outbreak of COVID-19, you see a really kind of phenomenal growth. And maybe, coming down, we'll come to the end of looking at the period 2019 and extrapolating to 2022. It's very different from what you get in advanced, economies. The pre-crisis level about the same, but what happens after COVID-19 is very telling in terms of the deviations, both the parts of the. And I think it's been phenomenal here in Sub-Saharan Africa with many countries. Zimbabwe has had a traditional, with money growth and inflation. That's it. Also, you can see quite a number of, including those of like Zambia. Basically, inflation has started to emerge even when central banks were beginning to forget about it. And in particular, the story here is, if we just to link this to the theoretical foundations, we find in particular in Angola, Ethiopia, Nigeria, the large economies, there's been a strong accommodation since COVID-19, monetary and fiscal policies, but also evidence of, not evidence, just insights into possibilities of exchange rate pass-through effects. As I said, the exchange rate pass-through is, computed on a monthly basis for these economies, and also because they want to form their the import capacity with the central banks, and of course also commodity prices, which have fueled the inflation pressures, and it comes in a new explanation of climate risk. And I think that it's possible that most of the models, say, before 2010, were not incorporating so much climate risk. But the amount of what you call the V20, I refer to another paper of mine for the UN, which came out in World Development last year, where climate risk is really an important phenomenon that shapes a monetary development. The risk is this climate risk is very important to integrate into our analysis. And then you have economies like Kenya and South Africa, where basically you have subdued demand. Of course, interesting is how have central bank governors reacted in the case of Sub-Saharan Africa. And you can see here is, taking a snapshot of some of the, countries. Here is where we have, the arrow rising, so for example, Seychelles, just rising the policy rate. Uganda still kept constant. Zambia rising interest in the policy rate, anticipating the inflation pressures. Sorry, and then you have, Ghana, stable, Angola, and so forth. So you see the kind of anticipating huge inflation pressure that has led to changes as a reaction. Latin America features some of these, and if we can go back to the theoretical underpinnings of this, one would relate to possibly inflation expectations, going up. And in particular in some of the countries, Costa Rica, Guatemala come to mind in the monitoring, but also the return of the common inflation management tool or monitoring tool, which was inflation targeting. The inflation targeting model had become so mainstream that I think I spent most of my time at the African Development Bank in helping many countries on inflation targeting models, mainstreaming inflation targeting models at central banks. So here in Latin America, you have a setting of inflation targets in some countries. Argentina, Bolivia haven't returned that, but you can see a setting a kind of a threshold, an upper bound, and of course a current target, and then an upper bound in anticipation of, say, high inflation. Mexico targets 4%, but then other bound is 5%. And you can see even the up to Paraguay was 6%. And so this is kind of anticipating a lower bound. They're saying that the transmission of inflation and maybe monetary growth as well is not declining. It's an upward trend. And in that region, we find that basically the commodity price channel, active in this. Inflation expectations are feeding into the process. And the amount of supply side inflation, these countries had a history of supply side inflation, and somehow some of it kind of persists. But thirdly, the exchange rate pass through, depreciation of the exchange rate in a special local pushing up inflation in most the response by central banks, if we can just try to decipher this from the monetary policy rate, you watch all these developments before COVID. Now, the interesting bit is around here, around this zone, where you find, a COVID outbreak. Then you get October 2020, and you get complete by October 2021, just 2 months ago, it's all in an upward trend. Of higher increasing the monetary policy rate in anticipation of further inflation. The Asian Pacific, again, we monitor the same developments, especially commodity prices. We see trying to distinguish between headline inflation and core inflation. But even you find that basically what is coming back is the inflation targeting rate increasing, higher inflation targets being put in place up to about 6% inflation targets by central banks. That's a huge, a very ambitious target, especially in economies that are more or less middle income economies, which are evolving away from low income countries. And that's in terms of central bank responding. Asia, in India, it's the same, but India was monitoring some cost push inflation. In China, a supply side inflation, especially producer inflation, if we refer back to the main variables in the model that we looked at, the empirical model we looked at. And then here, try to do a set of a number of countries, emerging Europe, Middle East. This is a group that is just put together for the purposes of this discussion. And trying to do a happiness and sunshine story, changes in CPI since the outbreak of the COVID-19 and changes in GDP since that period. And you see this unmistakable, trend, which is absolutely. Finally, in trying to hazard an answer on how central bank governors should respond, basically, there are not many degrees of freedom. We should bear in mind that the story that emerges from looking at Africa, Asia, and other countries, that developing countries are not homogeneous of degree one. There are variations that you can see in terms of the way they accommodate not only money growth from OECD, but also inflation pressures from OECD. And therefore, the responses would vary. But we should try at least to have an anchor on, say, 3 main identifiable responses which are possible, and which we shall try to, when we do the further development of this paper in the empirical estimation, we will be trying to look at, say, the return to inflation targets as a possible value. And indeed, some countries, as you can see from the presentation, have already embarked on this journey. The second is to watch the exchange rate dynamics, to watch what is happening, the exchange rate pass through. After all, BIS has an annual exercise in which central banks meet in Basel and compare these the deviations in the exchange rate pass through in the economies. And of course, counter-cyclical measures to dampen inflation expectations and inflation that arises from commodity price cycles around the world. We watch this space because one of the approaches we are thinking of is to take the COVID-19 as a kind of natural experiment that created perturbations from the behavior of the transmission channels, from the behavior of money supply growth in OECD and industrial countries, and also the channels through which that money growth has impacted developing countries, as well as how inflation has impacted developing countries. So we shall continue this story very soon. So we watch out in this space.